In this video, guys, we're going to look at the question, the most popular moving averages. What are they in trading? Stay tuned. Hey traders, a warm welcome to you. So this is a bit of an odd question really, but in a way it makes sense because people want to align themselves with what other people are doing. Now the caveat I've got for you before I do this video is to be very careful doing what others are doing. There's a bit of a kind of thesis that, hey, if everyone's watching the same thing, it's going to work, and that works to some extent. But really, I'm cautious about this video saying this is the moving average everyone uses because if anyone's watched the channel for a long period of time, by the way, appreciate your support if you have, and you've liked and you've subscribed and all that kind of good stuff, you probably know that I like to have a strategy and then fit an indicator or moving average around that strategy. So for example, if I am quite interested in a pullback strategy or a trend trading strategy, I'm going to find a moving average that fits in with my thesis of when I want to buy the pullback. Or if I'm interested in buying a slow churning trend, then what moving average crossover would help guide me. I'm nervous, even better, of anyone who wants to kind of put moving average on a chart and then use that to tell them how to trade. Now, we've done videos where we talked about moving averages filters, fantastic. Moving averages are kind of a starting point, fantastic. Crossovers, etc. can work when added with other indicators, but just be cautious about kind of saying, well, these are the best ones, I must use them, I must find it. Maybe reverse engineer from that. Anyway, with that caveat in place, let's get down to it. So the most popular moving averages, without a doubt, the most popular ones that most people are watching are the 100-day and the 200-day. These are longer term traders, bigger money, moving bigger money around. They're always looking at the 100 and 200-day. These are slower moving averages. They've got a long time to go, and when prices above the 100-day and the 200-day, people generally will consider that as bullish, which is the way around they consider that as bearish. If you've kind of got price above one and not the other, or one hasn't crossed, let's say price has gone back above the 200-day, but it's not quite, it's kind of a bit of a mismatch of stuff, then people will consider that as a range bound condition and it's very, very choppy. You don't get so much with 100 and 200 day. They have to be quite flat for a long time for those to flatten out, but when they do, that might be a warning sign that, hey, nothing's happening, but be ready for a breakout. So if you've got a flatlining 100 and 200 day moving average, you've been sitting in obviously a range for quite a long time, and if they've been kind of oscillating, or the 100 has been oscillating around the 200 like this because it's the quicker one and price has been doing that, then maybe an explosive move is about to happen, but be cautious. So there's those kind of things, a lot of interpretation you can take from looking at those moving averages, and many people will only trade when they see that, and many people also will wait for price to come down, test it, and say, well, it tested the 200 day, oh, it's a big significant level, and they'll look for kind of a weekly candle that wicks through, pushes back up, and take a trade off that. Now obviously there's not going to be that many trades that tick those boxes, but that's a very, very popular way that traders will look at stuff. All right, so I've got a bit of poetic license here because I'm kind of making a guess based on how many traders I've seen, and also my own kind of thoughts on this. A lot of traders, when they're swing trading, are going to use a 20-day and a 50-day as well. So the swing traders, the reason they won't use these is because for many swing traders, those are well out of the chart. If you're in a nice uptrend, the 100 and 200 day is a world away from price, so it's irrelevant, it's useless. It's better for longer term traders because they can wait for that to happen, and that might take a year or so. Swing traders are going to look at these smaller moving averages. 20-day is super, super popular. 20 is a theme that runs between all of these actually, guys, from a day trade. Look at day trading in a moment. So 20-day to 50-day, very, very popular, as are actually 5 and 10. And that might seem like, well, what isn't popular? But you can see there's a pattern here of what is. As we start to get higher out, then we start to move in bigger chunks. But people who are, if it's a very aggressive trend, a 5-day does seem too much, but actually that can add some very useful kind of signals, like multiple days closing above the 5 period is super, super aggressive, and very often traders will buy the first close below the 5 period after that for a subsequent move up. Same with the 10. The 10 might be keeping the trend very, very tight. 20 is more like, okay, the price has moved up, it's unwound enough to be still quite bullish, but just tagging that going on. That's really my preferred throughout most things, guys, is the 20 period. I try not to clutter up too much stuff. I've got a specific strategy that relies on the 20 period period to give me a kind of indicator of when I should be buying. Other than that, I might just put those others as a guide on from time to time, but I'm cautious about cluttering up my price. Okay, so let's look at day trading. I've put 10 minute and 20 minute here because it's going to depend on what time frame you've got. It should really be period, so let's just put a period there. But if we're day trading, let's consider we're looking on a 1 minute chart. A 20 period on a 1 minute chart works very nicely for those intraday trends. So a good trend move, pulling back, hitting that 20 period. 5's a little bit too busy, and it's so close to price, it's almost unreadable, and it's okay, I think, for trailing purposes. So let's say you're in explosive move, you trail your kind of exit on the 5 period. So if you're one of those people who wants to come out too soon, then maybe you can go, right, I'll trail it. Okay, we just go below it, bang, and it gives you that little bit of extra extension. So that's quite useful. A 10, again, a little bit noisy, but some people, it's popular with some people. So a 1 minute chart, 20. But if you go into a 5 and a 15, again, 20 is super popular. 10 works nicely on a 5 minute, works nice on a 15 minute, and a 50 if you're going bigger. But then again, if you're day trading, you might find it's too far away from the 50, depending on how time frame you're trading. So really, the summary is, bigger trends, the 100, 200 day. Smaller trends, mess around between the 10, the 20 and the 50. There's only really 3 there. Add the 5 in if you want to do something very specific, but generally speaking, unless there's a specific reason for it, just stick to that 10, 20 and 50 day. And if you're going really tight, longer out and the price is coming to those, because it's come back down into something on a 100 day or 200 day, they're worth having on as well, just in case you find some support there and some bit of confluence, etc. Because you know that longer term investors are looking at those levels to do some business at. Take care, hope it's helped, bye bye.